to me, this is very similar and eerily reminiscent of the end of 2018 and beginning of 2019. And if you guys remember, at the end of 2018, October, November, December, the markets just fell. And part of it was Powell's going to raise rates, inflation's getting out of control, et cetera, et cetera. And then we got all this data that said China may be entering a real period of malaise, and Powell capitulated, again, trying to stick the landing. And long story short, he didn't. That was a head fake, and the markets just ripped higher. Then we went into the COVID pandemic and all of that stuff happened. So I think we're about to replay a little bit of that, at least in the next 30 to 90 days. The pain trade is to go up. So that's probably where we're going.
Here's the Fed fund rates chart from 2000 and into the 2008 recession. And you see just, to Chamath's point, in 2019, that little step up to 2%, and then this dramatic step up that we've been on up to 4.5% or so. Sachs, is this where the Fed pauses? Do you think they cut? And what overall effect is this going to have on venture capital and the startup market, which is super important to us?
I think we're in the whipsaw economy here. Just a month ago, sentiment was incredibly negative. On this show, we were predicting for the year that we were looking at the Fed funds rate going from 4.5% to say 5.5%, 250-point increases. The belief was that we were going to have a recession later this year. I think that was pretty much consensus. And now 3 weeks later, you had a situation in which we got a couple of really good inflation reports. So all of a sudden the consensus changed to, we're not going to need to raise rates, to 5.5%. Maybe we only get one or two more quarter point rates. And the market just ripped on the belief that inflation was in the rearview mirror. The problem had been licked, and now we can just kind of move forward. And the Fed seemed to confirm that just yesterday with a quarter point rate increase. And now today we have this wild jobs report with over 500,000 new jobs. The expectation was only 100,000. And so now all of a sudden people are wondering, well, wait a second, does this mean that labor costs are going to, go back up, that the economy is overheating, and now the Fed's going to have to raise more? So I would say literally from week to week, we're being whipsawed between expectations of whether inflation has been conquered or not, whether the economy is going to have a recession or not. And I think probably where we're sitting at this moment is you'd have to say that the risks of inflation returning are slightly higher, but the risks of a recession are slightly lower because with this kind of jobs report, better chance of having a soft landing here.
It's very hard, in other words, Sachs, to have a recession if people are employed. If people are employed,
well,
and we have
when you're down to 3.4%. Yeah, exactly. So
50-year low.
Right. So I just think that we're in a highly volatile economy and it's very hard to predict the future. I'd say that relative to where we were a month ago, you'd have to say that the odds of us having a soft landing this year are quite a bit better than they were just a few weeks ago.
All right, Freeberg, when we look at this employment picture, it does seem people are going back to work. Seems maybe indicative of people blew through their savings. We talked about this. You've been harping on and on previous episodes about people doing personal debt, buy now, pay later. Is a possible thesis here that people YOLO'd for so long, post-pandemic, Coachella, vacations, etc., that maybe they whip through their savings? It seems like we've burned off $1 trillion in savings or something like that, and the debt's going up. So now people maybe need to go back to work, and they're finally capitulating and taking jobs. Do you think that's what's actually happening here?
I don't know if I would classify that. I mean, there's obviously a lot of this stuff is on the margin. The one challenge, Larry Summers has been harping on since last spring, all the way through the summer and the fall. And, in multiple kind of interviews and publications he's done, he's the ex-U.S. Treasury Secretary, obviously brilliant economist, that the U.S. needs to have a 5 to 6% jobless rate for 5 years in order for us to really get to the inflation rate target of 2 to 3% or below 2%. And so, the economists and the macro guys that are tracking their jobs report today I think the indication is we're not there yet. And that the implication of a tight job market is wages go up, and wages go up, inflation goes up, and because companies need to charge more because they have to pay more to get talent. And this obviously continues to support the escalatory spiral that drives inflation. So that's the kind of downside to the jobs report today that I think a lot of folks are watching.
The Fed mentioned over and over again deflation. So any impact there, Chamath? You think we're going to see prices start to crater? And what impact would that have on the market?
I think Sachs is right. I think the marginal risk here is for this whipsawing. So we have a period now which is disinflationary. But the problem is if the stock market keeps going up and all of a sudden we have less restrictive monetary conditions, then we're going to be back at the same place we were before, which is money sloshing around into all kinds of risky assets or more money. There's still an enormous amount of money sitting on the sidelines that has to come into the market now if this thing keeps going higher. So we're in a delicate moment. And if we reignite inflation because all of a sudden more companies have more liquidity that they can tap, right? More money they can raise, more money as a result that they can spend, because we don't have this first inflationary cycle under control, there could be a risk that we reignite inflation. And so then they have to capitulate, the Fed has to capitulate again and start another hiking cycle. So I think it's a complicated moment. I think all of the smart money in Wall Street that I talked to up until this point, they forecasted like this period would be choppy and the second half of the year would be really robust and like you needed to be super long and things were going to be incredible. And when I talked to them this week, they're like, oh God, we weren't positioned for this. We had no risk going into this. We're going to be forced buyers. There's a bunch of companies that are whispering that they want to go public now.
Oh,
and
really?
So the big banks have been calling around trying to book build quietly for some IPOs. And so if they try to kind of crack this capital markets open, I think there's, again, the marginal risk will be that we do whipsaw, as Sachs says.
When you say book build, you mean trying to see if you'll get some early takers to buy equity in an IPO, perhaps even in a company like Stripe that's been sitting on the sideline?
So not Stripe, they're in a complicated moment. But when they call it to book build, they basically say, hey, listen, XYZ company, quiet filed, look at the S1, what do you think? Where's the price? Blah, blah, blah. And they're trying to get an indication of whether you'd want to be in the IPO book. So I think that there's a lot of those testing the waters that are now starting again.
Would there be an appetite in your mind for an IPO in the second quarter of like a Stripe type company? Putting, I don't know what the other candidates are, the lead candidates, but Stripe is the one people talk about most.
The thing that we have to think about is like most of the market are not people, right? Most of the market are computers and algorithms and ETFs. It's an extremely formulaic buying model. You have components of an index. Those represent certain percentages. You have to own those percentages to be relevant.